Welcome back to our intermediate financial accounting class. Over the last few segments, we've been wrapping up our discussion of income from operations, talking about some of the most current and most important pieces of our income statement: revenue recognition, pensions, and leases. Now that we've wrapped up that discussion, let's take a look at our overall structure or framework for our intermediate accounting series. We've finished the accounting cycle, we've talked all about the balance sheet, we've talked about income from operations, and now we're going to move into a module that finishes off our income statement, talking about other gains and losses, and then talking about our income tax expense and our earnings per share. Now, in this topic of other gains and losses, we could put all sorts of stuff here. PP&E sales, losses due to lower of cost or market write-downs, all sorts of gains and losses from our pensions, right? Net pension cost goes down here as well. So there's all sorts of stuff that goes into this piece, but we're going to focus on one of the most important pieces, and that is what we record for the stocks and bonds that we invest in as a company. You see, this is a really important topic as part of our income statement because some of it gets recorded, some of it doesn't, which means if companies structure it just right, they don't show these gains or losses. So we have to be careful understanding what exactly it is that companies have to report and how they show up on their income statement, and understand where to look for it if these gains and losses don't show up on the income statement. So there's some fun elements here. Also, it's just fun to see what companies are doing with stocks and bonds since we get to make the same investments. So this is a fun section. Now, why do we care about this? Well, investments are becoming a more and more important part of the business world all the time. It used to be that companies focused almost solely on whatever their core competency was. But now companies are diversifying through sales and mergers and acquisitions and diversifying their business. And part of that includes buying out rivals by purchasing their stock. In addition, companies now are often planning a little bit more carefully for their future expansion, which means they're trying to save up money so that they have the funds they need to expand, or to handle a pension, or to repay debt. And the purchase of investments is one of the ways that companies can save up the resources that they need for these future plans. Companies may choose to buy stock in other companies for other reasons, not just to save, but also to control their supply of raw materials, to be able to increase demand for their products by buying stock in one of their customers. They also might decide to merge with a rival or create a stock portfolio that will allow them to mitigate their risk. In addition, companies will invest in bonds and other commercial paper, different kinds of debt. This allows them to avoid volatility in the stock market. It allows them to ensure cash flows over time if they're buying a security with a series of payments, or even just a lump sum at the end. In addition, the bond market allows them to finance subsidiaries or parent companies that may be having trouble. And of course, we need those companies in business so that we can stay in business. So providing them with debt financing is a way that we keep these clients or these customers or these suppliers or our parent company or our subsidiary company in business so that they can grow. From an investor's point of view or a manager's point of view who's trying to do an assessment, understanding the classifications of investments allows us to understand what a company is trying to accomplish with its investment strategy. If we know where they're putting their securities and the kinds of securities they're buying, then we have a better insight into what they're doing. We also have a better insight into the kind of profit they're reporting or not reporting, because some of it doesn't get reported, but it's important all the same. So we want to be able to know where to look for these different kinds of profit so that we can use them in our analysis of a company's progress. Investments have become such big business that we see almost every company now making some kind of investment decisions. And most of us are making investment decisions as well, for our retirement or saving up for a vacation or to buy a new car or to put a down payment on a house. These are really important issues. And while we won't focus on the decision side, how do we decide whether we want to do this or not, we are going to focus on what investors see and how we can assess them. And that's important for us. And it all starts with understanding how accounting and GAAP break down the different styles of investments. The first of these categories is stock investments. And we can break these stock investments down into three categories. Now remember, stock is ownership in a company. We're trying to buy the voting rights. Now sometimes we buy them because we want to control the votes And sometimes we buy them just because they're a good deal. I can trade them on the market and make some money. And the first two categories that you see here, the accounting categories, are about securities we don't want to own as far as a vote goes, but we want to buy and sell to make some kind of a profit. The first of these is trading securities. And trading securities are those that we actively trade. We want to buy and sell them on a regular basis and have some kind of a plan to buy and sell these securities. You'll often see these referred to as cash equivalents because they turn into cash so quickly that we might as well treat them as cash. All it takes is one call to the broker and we have all of these funds. The next stock category in accounting is available for sale. And available for sale are stock that we have purchased to save up for a specific purpose. So I know that I'm planning a big expansion in 10 years. I need to save as much money as I can. I'm going to buy a bunch of stock and I'm going to hope that it appreciates over these next few years so that when I'm ready for that project, I have the money. So we see this as expansion funds, we see it in pension funds so that we can fund our pension, and we see it in debt repayment funds. Those are the three most common categories. Now the reason they're called available for sale is even though we intend to wait and sell them when we're ready for this money, if a really good deal comes up, I'm going to sell them. So they're available to be sold either in 10 years when I need the funds or when it's just too good to let it sit. The last of these categories for stock investments are equity securities. These are stocks that I have purchased for ownership. I want to control this subsidiary. So I don't care about the market price of this stock. I don't care what's happening with the market at all because I didn't buy it for an investment that I'm going to buy or sell. I bought it as an investment in control. And I treat that very differently than I do trading in available for sale. The nice thing about trading in available for sale, by the way, is the fact that they get treated almost identically. Just a minor difference in the account titles used, but the methods themselves virtually identical. The next major category of investment are debt securities. And again, you can see that for accounting purposes, we've broken these debt securities up into three categories. Now, when I think about debt securities, I typically think about bonds because there's a huge bond market in the United States and companies are constantly buying and selling them. Now, because of that focus for most of us and for most companies, we're going to focus our discussion on bonds. But just be aware, there are other kinds of commercial paper. Since the methods are the same, it's okay that we focus on bonds. But just be aware, at least theoretically, that there's a lot of other kinds of debt that's being sold out there. One good example of this are the mortgage securities that people were buying and selling that led to part of our market crash just a few years ago. So that's one example of the kinds of securities, debt securities that are out there. Now you can see that we've broken debt securities down into three categories, and the first two are the same. Trading securities that I'm going to buy and sell on a regular basis because there is a bond market and other debt markets. Available for sale, which is just like available for sale for stock. The only difference is now instead of buying and holding shares of stock, I'm buying and holding bonds or other commercial paper. And while I may be getting interest payments, I'm not really focused on the interest payments. Instead, I'm focused on buying them now, and then at the end of the 10 years or 20 years, when I'm ready for that big project or I need to start paying my pension, I can sell these bonds on the market and get the money that I need to continue on with this obligation. So that's what we're doing with available for sale bonds. And again, if the price skyrockets for some reason, it's available to sell, and I will sell it. The last category is what we typically think of when we think about a bond. It's held to maturity, and it's what we did back in our discussion of receivables. I have purchased this bond or this other debt so that I get the debt payments. I don't care about the market value. I'm not trying to sell it or buy it on the open market. Instead, I purchased it for the right to get the interest payments and then the principal payment at the end. Now you can see that there's some similarities between stock and bonds, right? Trading, I can have debt or equity. I've got available for sale, be debt or equity. And then I have one category that's unique to each major type of security. I can have equity securities that obviously can't include debt because I bought it for ownership. And I can have held to maturity securities which are purchased for debt repayments, which obviously would not include an equity stock at all because we don't get specific payments from equity stock. So that's how we break down our two major classifications for accounting purposes. Let's talk about how we record each of these different styles of investment. So first, let's talk about the trading securities. These are recorded at their fair or market values on the balance sheet every period. So anytime we prepare a balance sheet, we're going to go find out what this stock is selling for. And even though I haven't sold it, we're going to put that fair value into our balance sheet. Then any gains or losses from recording this change in fair value will go right onto our income statement. Now, it doesn't show up like a normal gain or a loss because these are unrealized. I didn't really sell these securities, so I didn't really make the gain, and I haven't really suffered the loss. So we just call them unrealized, and they still go in the same grouping with other gains and losses, but they're different because of that unrealized title. I haven't really sold this stock or these bonds. The next are available for sale securities, and again, I'm going to record the fair value or market value on my balance sheet. But because I'm not actively buying and selling these securities like I am with trading securities, FASB said you're not allowed to put this gain or these losses on your income statement because the gains and losses here are because of market fluctuations. You didn't control them, you're not trading them, so you can't put them into net income. So instead they become part of comprehensive income, which is basically a holding category for any changes that I don't really have anything to do with. Changes in these market values, changes in my currency translations, changes in pension fund values, etc. So these don't hit the income statement. They're still unrealized gains or losses, but they get stuck in other comprehensive income on the balance sheet below retained earnings. Once we sell the investment, then we put the gain or loss onto the income statement, and that's the same for both trading and available for sale. Now we have a real gain or a real loss because I've really sold it, and that always goes on the income statement. Now I want you to focus on one key idea here, and it really is a key concept for us when dealing with investments. It's the fact that for the first time in all the different assets that we've talked about, we're recording these two at fair value, not historical cost. These are the only assets right now under US GAAP that we keep track of at a fair value as opposed to historical cost. Very important distinction from all the other assets. And the reason FASB has allowed this is because we know exactly what trading securities and available for sale securities are selling for, because there's a market for them. And you can buy and trade them just like that with a call to a broker. So because they are so liquid, even if you're planning to save them as available for sale, they're still very liquid. And because they do have a specific market value, we can record these at fair value. Again, first time ever. Very important key concept when dealing with investments. Let's talk about the other two. First, let's talk about held to maturity. Now, again, we've done something with these already in doing our receivables. We talked about loans receivable and notes receivable, long-term receivables. That's what we're talking about here. This is just a different way to say it, held to maturity security, and we're just differentiating because we're going to hold on to these throughout the whole series of payments, and then we're going to get our principal back at the end. So this time we're going to record these at the net present value. Which is basically the historical cost plus a premium or minus a discount. That's what we're talking about with this amortized cost or the net present value. And that's the amount that's going to show up on the balance sheet. The interest revenue is going to be included on our income statement, and we're going to use the amortization of the premium or the discount to help us keep track of what exactly that interest revenue should be. And we can use the effective rate or straight line method to determine what that amortization will be. The last category are our equity securities, and these are perhaps the most challenging to understand the first time through. So let me just explain the differences between equity securities and everything else. First, you have to own at least 20% of the stock in a company before you can classify it as an equity security. Now, when we say stock, we're not talking about like preferred stock. We're talking about common stock with voting rights. And we have to own 20% of the voting rights in a subsidiary in order to classify it as an equity security. Up until that point, we usually stick them into available for sale because sometimes I can't buy 20% outright. I can buy 10% now, 5% later, another 6%. Finally, I can treat it as an equity security. But for those first couple of years while I'm trying to get to that threshold, I can classify it either as trading or available for sale, but not as equity. Now, most companies choose to classify it as available for sale because they're not actively trading this stock, they're just holding it. but it is up to the company where they want to stick this value until they get to equity securities. And as long as they're classified as trading and available for sale, I'm reporting the fair value on my balance sheet and either a net income amount with gains or unrealized gains or losses if it's trading, or a comprehensive income amount if it's available for sale. Once we reach that 20% threshold, it changes drastically. I no longer care about market value. Instead, I'm going to keep track of the changes in the subsidiaries' retained earnings balance. So if their retained earnings goes up, my investment account asset goes up. If their retained earnings goes down, my asset goes down as well. So it's very different from the other methods that we've been talking about because I'm totally pushing away the market. I'm not worried about a series of payments like I am with held to maturity. I'm literally keeping track, now that I'm a major owner in this company, of my net assets in that company. And I do that by using the change of value in its retained earnings. As part of that process, what goes on my income statement as a parent company is my portion of their net income. I'm actually going to show that as income from subsidiary or a loss from subsidiary. And it's going to go on my income statement because I'm the company that chose to invest. And I have a significant share of voting stock, and I can control what that subsidiary does, or at least influence what it does. So now its profit hits my income statement. The last thing I want to mention, and this is the weirdest thing of them all, is the fact that once we get to that 50% threshold, we do a special adjustment called a consolidation. Now, consolidation is way beyond anything we would do in intermediate accounting, so we're not going to actually talk about how to do it. But just so you know, what consolidation means is that I take my books and I take my subsidiaries' books and I mesh them and put them together as one set of books, and I report them together. And it's a very involved process trying to figure this out. Again, I have to own the majority of stock. I control this company because I own 50+% of the stock. There has to be a little over 50 so that no other group of owners can get together and gainsay what my vote is. So I have to have real control with 50% or more of its stock. Now, I wish we could go into it in more detail, but it's a topic for other chapters, other classes, other discussions. We can't have all the fun here. Wow, lots of information, isn't it? There's just so much to take in with investments because they're very different from all the other assets we've talked about. But you can get it. It's going to be very easy as we walk through it step by step, and that's what we're going to do next time as we pick up with an example. I'll see you then.